Years ago, when I was running my Motley Fool Income Investor newsletter, I was doing some research on energy stocks. And I was at a cabin in the mountains over a weekend, and my dad was there too. And I was reading some smart sounding commentary. I think it was on paper at the time. And I left the room and I came up, my dad was reading it. And he has spent his career in energy. He knows it very well. He looked up at me and said, "James, this guy is on the beam." This guy, it turns out, was Roger Conrad, the gentleman across the screen from me, and easily the most knowledgeable person I know in the area of dividend-paying energy stocks. Roger Conrad writes an investment newsletter called Conrad's Utility Investor, and now a Substack newsletter called Dividends with Roger Conrad. So in addition to being on the beam, Roger also feels we're on the brink of a new and very beautiful era for utility investors. So if that piques your interest, and it should, please keep watching. Roger, welcome.
Thank you. Nice to be.
So, Roger, I was looking on your website, and I love that you focus on utilities. I like to say boring is beautiful, and as you heard me say, I ran Income Investor for 10 years, which was Motley Fool's dividend newsletter. I picked a lot of MLPs, a lot of utilities, some pharmas, but mostly dividend stuff, and very heavily in energy. And I freely admit I'm in the presence of greatness when I talk to you, because I know a little bit, you know much more. I'm going to open up a few topics. Let me start with one that you referenced on your website, though. Utilities had a terrible year last year relative to the S&P, relative to the Magnificent Seven. I think 24% of stocks in the S&P 500 outperformed the index itself, which is a new low, meaning it was a few big companies carrying all the weight, and utilities definitely were the laggards. But you think things may be primed to reverse. Can you walk us through that?
So I think a lot of the reason why utilities lagged so badly was it basically had to do with the Fed, obviously. And I've done a lot of research. Typically, what happens with interest rates, long-term interest rates particularly, doesn't really have a lot to do with how dividend-paying stocks like utilities will perform. So in other words, going back like 40 years, say, there have been just as many years where utilities, real estate investment trusts, dividend-paying stocks in general had good years where they generated good returns, say 10% plus, including the dividend, and interest rates rose. And in fact, some of the biggest years we've had for dividend-paying stocks have been actually in years where interest rates rose. Well, why?
And that's against prevailing wisdom. If someone's new to this, when
Totally.
rates are rising, it's supposed to be bad for utilities.
And I suppose we should back up and say why that is the case. It's because, or why that has become the conventional wisdom. That's because utilities pay dividends. So if interest rates rise, yields on other things like bonds, returns you can get, will be will rise, and so therefore the utility dividends will be worth less. That's kind of the underlying logic, and it does make a certain amount of sense, but it really doesn't pan out. In fact, what you see these stocks doing is basically performing with other stocks. In other words, years where the S&P is up, the utilities are going to be up as well, and that's because the economy's better in those years. So the earnings utilities have, the dividends utilities have, those tend to get better. Those tend to grow. So that's why they tend to participate in stock market rallies and so on. And the opposite is true too. So in years like 2008, when the stock market was down, the actual benchmark interest rates halved. I mean, the 10-year Treasury note yield halved over that period. And the Fed was, of course, cutting rates and everything, trying to boost the economy. But utilities had a horrible year, and that's by far the worst year they've had. I guess really going back a pretty long way, maybe to the Depression. So
Wow.
Yeah, so they don't really follow interest rates, but in this particular case, they have been very much affected by what's happened with interest rates. One factor I think people have noticed is the money market yields have gone up a lot. So money market mutual funds very low risk way to invest. They just pay you interest. The value of them never changes. So that's become a very popular alternative to the utilities.
Yeah, if I can get 5% in a money market, getting 5.1% in a utility, it doesn't seem so attractive, basically.
Absolutely. And then at the same time, the business case for utilities, which has been pretty strong, it's based around how much money they're investing in their systems. And right now, we're in a period where electrification is a very big goal of not only the government, but also businesses for obviously for cleaner energy, but also because less variation in energy costs. We've had a lot of ups and downs in oil and gas prices, for example. That affects the rates we pay for electricity. Obviously, it affects what we pay for automobiles and so on. So there's a big drive to that. Utilities are spending money on their power grids, on different forms of energy, natural gas, but also solar, wind, and so on. So all that money gets spent. It goes into what's called rate base. It increases utility earnings. It means they can pay higher dividends. So it's kind of a value proposition that's built in over the last few years. Well, to keep a long story from getting longer, what happened over the past year is that case has been somewhat undermined by rising interest rates, because in order to do the spending, you got to either issue stock or you got to borrow money. And what's happened with borrowing money? Well, companies were once able to borrow at 2.5%, say. That same loan now, or at least towards the end of last year, was going to cost them 6.5%. Obviously, a big backup there, and a lot of people started to question whether that would cause utilities to start spending less. Well, what we found is that that's not been the case. Utilities have actually stuck to spending plans. They've been able to do that for a variety of reasons. One, before the Fed started really pushing up borrowing costs, because that's where interest rates are important, the borrowing costs, basically. Before they started doing that, utilities had been locking in a lot of their capitalization, their bond by issuing very long-term bonds at very low interest rates. So they really haven't had to borrow a lot of money to refinance debt. So that's one thing. They've also been able to lock in a lot of the costs of projects that they weren't able to do. A lot of people remember back in the 70s when they were building massive nuclear plants, coal plants that took a decades plus to build. In contrast, today, the projects, solar plants, for example, or grid, making that grid more stronger, more resilient. Those are projects that can take place within the course of a year. So you can really predict the costs a lot better. And that includes the cost of financing. I mean, you can lock in the money. Whereas with a long-term project, you have a lot of potential in times of inflation, in times of higher interest rates, for those costs to really mushroom and become something entirely different than what people believe in. So they haven't had that problem this time around. And then finally, the federal government's made things a lot easier with the Inflation Reduction Act, in particular, which is mainly a massive tax credit plan that advantages all sources of energy, from nuclear power, in fact, even oil and gas, but of course, solar, wind, all this various thing. And now the government's allowing the companies to actually sell those tax credits that they've gotten under this plan. So that's another massive source of finance that is kind of offset. So what we found, I guess, is that we haven't had this earnings Armageddon that I've been saying. And now that borrowing costs have actually started coming down over the last 3 or 4 months or so, and this is something you don't see commented on very often, but because the Fed really hasn't done anything with interest rates, they've talked about cutting rates, but actually the borrowing costs, and particularly longer term debt of these companies, their borrowing costs have come off dramatically over the last 3 months. So now they can issue 30-year bonds, say, at about the same cost as they could at the beginning of 2023. So that's pretty remarkable. And I think it makes again, a kind of an earnings Armageddon or undermining that much less likely. Now, utility stocks are pricing in that kind of thing. They're pricing in a big kind of retrenchment. And if that doesn't occur, and again, I think the odds of that happening are dropping, almost daily. That's a pretty good case for them getting what's called a revaluation, which would mean push up to much higher prices. So we saw in 2000, which I think is a year that is very similar, the 1999-2000 is very similar to what we have today, 2023, 2024, in that in 1999, the Fed really started tightening interest rates to try to rein in inflation that had picked up. There was a financial crisis in 1998. And in so doing, there was, at the same time, there was a massive rush to technology stocks and out of dividend paying stocks. And that occurred in 1999. And it was an historic underperformance of utilities versus the S&P, but also the S&P was being driven by, the big technology stocks, which were most of the index at that time. Same thing has happened in 2023. In fact, the tech stocks are now about their largest concentration of the S&P as since back to 2000, early 2000, late 1999. And of course, the Fed's been doing the same thing. It's been trying to rein in interest rates, and it's kind of on the verge of a pivot. We don't know when exactly that's going to occur, but eventually looks like they'll start cutting interest rates again. So again, pretty similar circumstances. And I think you put that together, you've got a pretty good case for a rotation into utilities. The yields are pretty high, so you start out that much ahead. Companies are still increasing those yields. We do have a big batch of earnings coming in relatively soon, so we'll see how companies did in the fourth quarter, whether that momentum was maintained, and more importantly, whether management is still sticking to these pretty robust guidance. And I think as we see those, I think we will see that sort of positive environment reaffirmed again. And I think we'll start to see money rotating in the stock market into stocks like utilities. And I think, in 2000, the Dow Jones Utility Average was up better than 50%.
Wow.
I don't go that far, but even half of that will be, of course, a tremendous improvement on last year and really good for investors.
It's interesting, especially the rates dropping in advance of the Fed moving, because, traditionally, habitually, we think that the Fed fund rates precede everything else. But, first of all, that's between private banks at the Fed. The Fed just kind of suggests it, sort of like the Godfather, make an offer the banks find hard to refuse. But
right.
The utilities are borrowing on the long end of the yield curve. And I guess what you're saying is that kind of does its own thing. And with the inverted yield curve already happening now, though whoever is, loaning those, the bonds to the utilities are okay with those lower rates. And it sounds like you're also saying utilities kind of jumped the chasm, meaning they were smart. They loaded up on the cheap debt when they could. They held their breath. They didn't need to borrow for a while. And now that they're finally going back to the market, the rate, I mean, still rates are high, but they're coming down from their crest. So I think you're right. I haven't read anything about that except hearing it from you. So that's probably a very bullish sign for these utilities.
I think so, and I've been looking at this sector for a really long time. I started out, I guess, in the mid 80s doing some research for another analyst at the company. I started with a newsletter called Personal Finance. And, it was a different kind of sector back then. I think they got really slammed by deregulation. So, of course, I went through that whole event, and things were pretty exciting. And a lot of the managers were kind of swashbucklers at the time. Enron was the model. And of course, we know that story. But since the fall of Enron, it's really been a different story. The business has been really much more conservative, I'd say, financially, operationally, not culturally. It's very much opened up to, I mean, it's a much different business, and they've made this decision too. It's like we have to replace all these. You know, the business went from being very heavily, I guess, blue collar to very heavy
Mhm.
tech, and they had to attract a younger workforce. So these are actually some of the most, I guess, green or whatever companies around, which sounds weird, and it's a big difference from 40 years ago, certainly. But uh, they've tended to be, I think, much more in swing with what things are happening, which I know totally goes against the image of the utilities. And there's definitely a presence in the media, particularly anytime there is a rate increase or something announced, or we're in a period of inflation where there's more cost. You know, you still get kind of the same kind of utility bashing instinct, and also with politicians and so forth. But it's just such a different industry from what it was 20, 30 years ago. And the people are very much responsive to politics. It's which, you know, as an investor, that's what you want. They have to, because they're regulated companies, they've got to stay in sync with the politics around them. And you know, and if they don't, then bad things are going to happen for investors. But if they do, then uh, it really does reduce the risk and increase the potential reward. I don't think that's widely recognized at all.
Yeah, well, I mean, look at a company like Florida Power and Light or NextEra now, right? I mean, that used to be old school Southern U.S. and in Southern U.S. utilities tend to have very buddy-buddy relationship with the regulators. You know, they had good terms, whereas, you know, Illinois or you know, New England, those were a little bit more combative relationships. California, right? California kind of had their wake-up call, obviously, and now NextEra, formerly FPL, right? They're the leader in alternatives. If I'm recalling correctly, right? I mean, it's like a moth into a butterfly, just quite a different company. If you'd, you know, gone to sleep for 20 years, you wouldn't believe it.
Absolutely, that's absolutely right. In fact, they're the only U.S. company that has generation of renewables on a par with the big five Chinese companies.
Hmm.
And they actually do business with a company called Jinko Solar, which is one of the big Chinese. I mean, they're very solar panel manufacturers. I mean,
Yeah.
they've adapted. They had, and that's actually a really interesting story, because I do know personally, actually, one of the people who kind of got all that rolling back, you know, a decade or two ago. And they just saw that they were going to be first movers in the space. They saw that we would be using a lot more solar and wind and so forth. And they did the hard work. They went around all these little communities and talked to people, and that's still how they do it.
Is there still a grid play? I mean, when I was deeper into this, you know, everybody would talk about how horrifically ancient the U.S. power grid was and how it needed to be upgraded. So companies like National Grid, a British company, actually was in here doing some work. Texas is its own beast, right? Texas very deliberately wants to be not regulated by FERC. And you know, they've had their ups and downs because of that. But nationwide, do you think there's still a grid play?
I think it's very like anything else in this business. You have to kind of look at it project by project. You know, and that's what happened with like this offshore wind boom that everybody thought was going to be so explosive a couple of years ago. Now it looks like it's going to be maybe, you know, a quarter the size. They're still going to build things because there's still projects that make sense, but a lot of cancellations and a lot of postponement of what a lot of people thought. Again, just a couple of years ago, and what happened was rising interest rates and so forth shifted the economics. So I think all these various grid projects, you really have to view them that way. And so it kind of comes down to who's building them, you know, who they're talking to, what have they lined up their costs. But there's obviously a huge need for more spending on the grid, you know, and you're seeing it in where places where it's supported. You're seeing it to a large extent. For example, you know, Edison International, we're talking about California being considered one of those problematic regulatory environments that kind of is shifted over a little bit. Well, you know, wildfires are going to be a big problem out there, and they've gotten worse and worse every year. But Edison International, Southern California Edison's parent company, has, according to Moody's, reduced the risk of wildfire in its region, wildfire liability, by upwards of 80% in the last 5 years by installing covered conductors. Of course, at which, when there is a fire, it doesn't, the power line's not going to spark up and uh, worsen it, or there's a lot much less chance that it's actually going to spark a wildfire when there are big high winds and so forth. And you see that with PG&E. I mean, throughout the West, an appreciation that this is going to save lives. It's certainly going to save a lot of property damage and a lot of litigation. So, there is support for making those kinds of investments. Whereas in some places, there's a lot of NIMBY with grid investment. Obviously, it's pretty disruptive when you're going to build a giant power line. So there's a power line being built coming to bring Canadian hydropower mainly to New England. It's being built by a company called Avangrid, which is a unit of Iberdrola of Spain. And this project is just, it could have been in service several years ago and New Englanders could be paying less for power, but the locals have managed to block it over and over again. And in fact, there was like a referendum recently in one of the states that it would pass through. And the residents this time around, though, rejected it. So, but that's the kind of thing. These are massive projects. They take a number of years. And so they become problematic when there's political opposition that could extend them, right? Because just like the old projects of the 70s and the 80s, when people were trying to build nuclear plants and it took, they were originally going to take 2 or 3 years, but they discovered more things along the way. We had 3 Mile Island. And so they started taking 10, 15 years and the costs doubled, tripled, and so on. So no one wants to do that. And I think that is going to make, again, the overall pace of spending slower, but also it kind of, as an investor, you sort of have to look at project by project.
Yeah. And for someone new to this space, NIMBYism is a huge problem in energy. I mean, I was a vegetarian for 6.5 years, but I think if every meat eater has to work in a slaughterhouse for a little bit, like we'd have a lot more vegetarian. I do eat meat now, I eat organic or humanely raised meat, but it's sort of a parallel with energy, right? It's something that's kind of out of sight, out of mind. And I remember, we live in the same area, Roger. I was in West Virginia in a beautiful area, and some lady came over with this petition. It's probably 20 years ago, saying, "Hey, sign this. We're trying to block these wind turbines because they're unsightly." I'm like, well, look, I know that you care about the view shed, lady, but do you think blowing off the tops of the mountains for coal is better? I mean, there's no perfect balance. There's a trade-off in all electricity generation. There just is, whether you're killing salmon, whether you're chopping up a mountain, whether you're putting up wind turbines. I mean, there's no perfect fix, right? Or you got intermittency if you got alternatives, right? And people forget about that. So that's been an ongoing challenge. Let me jump there. You mentioned nuclear before I forget. So nuclear is a hot button issue. Speaking of people pulling back, we pulled back on offshore wind. We've had some pullback on some budding, these smaller nuclear facilities now too. I'm looking at an EIA number. Nuclear is currently 20% of our generation, but by 2030, it's projected to be just 18%. The big story there is renewables jumps from 24% to 49%. So I don't know that that's a reduction per se in nuclear. It's just an expansion of other things. It takes time, Roger, to build the nuclear plant. There's a lot of permitting. It's a big nightmare. The construction takes forever, but it looks like EIA is not projecting a big renaissance. Do you think they're wrong?
I think they're right because, we just had 2 new nuclear reactors enter service in Georgia. Or actually, one's in service, the other is nearly there. And Southern Company is the builder, so one of the biggest and strongest financially utilities, in the world. They started trying to build this thing, 15 years ago. So they thought it was going to be much faster. It was built on this AP1000 design, there were other orders around the world, particularly in China. So they had other companies, sister companies there. They could go and, compare notes. But they did a lot of things that were really smart. I mean, they got pre-approval pretty much for the whole thing. They got funding from, specialized loans from the U.S. government. They got a fixed price contract with Westinghouse to build it. But of course, what happened? Well, it took a lot longer to build it than they thought. I mean, we had one reason being, what happened with Fukushima, kind of put everything on hold, and up and down the chain. And just the cost started to, the time started to go, the cost started to explode, and Westinghouse, of course, went bankrupt, right? And when your contractor goes bankrupt, if you've ever had work done on your house on a smaller scale thing, right? I mean, you kind of have to scramble, but they did manage to keep the project going because they are who they are. I mean, they're huge, and the Georgia Public Service Commission committed to it. So they had all those elements working for them, and still, at the end of the road, they still had a lot of people second guessing, what rate increases there were to pay for the remainder of the plant, because they were getting those rate increases little by little as it was going along to avoid a big rate shock at the end. Another very smart thing they did. But I mean, is anybody going to commit to the same? Is any commission going to commit to the same thing given their example? Because it was well over budget. The project was well over budget, depending on what you consider, 2-3 times what they thought would spend. I mean, the effect on ratepayers, because they were getting the rate case, one little by little, is much less than it would have been putting it all through. And they avoided a big write-off at the end, which did happen to them back in the early 80s, when they brought the first 2 reactors there. So that's just a lot of conditionals for building a big reactor. So that's why no one has really come forward to talk about it. And they have talked about, you mentioned, the modular, the SMRs, the smaller nuclear reactors. And we've seen even those projects, that the one out in the Rockies, I guess.
Yeah.
And so it's something that, people talk about almost with a religious zeal. But again, it's sort of it's a project by project thing. Have fewer obstacles, I think, to doing that. A lot of other countries have fewer, less NIMBYism, I guess, or less effective NIMBYism, where they can actually block stuff. They have less or more commitment, or the government is funding it, whatever. I mean, they still probably have the same challenges in terms of, in the AP1000 reactors. I mean, it was a first mover technology. So even the projects in China were, higher cost and took longer. But it just, in the United States, it is much more difficult to get all that done. And then, of course, they've been competing against very cheap homegrown natural gas. And of course, there's not a lot, there's inadequate pipelines for that, more NIMBYism.
Yeah. And we're still flaring, right? In some places.
Yeah. So we have a lot of cheap gas in Appalachia, but New England will rely pretty heavily on imported liquefied natural gas, to stay warm this winter. So there's all kinds of stuff like that.
Which doesn't make sense. Like, if you just were beamed to the situation from another planet, you'd be like, wait a minute, New England is not too far from a lot of gas in Appalachia, right?
Really close.
Yeah.
Not a long drive. No, that's right there. Yeah, but definitely they, but again, even with these kinds of economics, it's still hard to get a nuclear plant approved. And in fact, I think the reason that nuclear will stay 20% or 18%, whatever, somewhere in that range, is that the NRC, Nuclear Regulatory Commission, is extending licenses of the existing plants, and they figured out ways to keep these running. But of course, you can't. That won't be the case forever, And they initially were built with 60-year lives. Now those are all extended to 80.
Mm-hmm.
Maybe they'll find a way to extend them to 100, but because nuclear is the largest source of baseload, carbon-free power. Also other, emissions, right? So they want to keep these things running. There is a constituency that wants to shut them, like they did in Germany, but I think maybe looking at what happened in Germany is also further increasing the appeal of just keeping the existing ones running. So they're actually talking about restarting some ones that were shut. There were maybe a half a dozen reactors that have been shut in the last 10 years. And people are talking about maybe restarting them. Well, of course, restarting those, there was a reason why they were closed in the first
Shut
place.
down, yeah.
Yeah, they were losing money. So, they won't lose money if they can charge a certain amount. But if there's if there's natural gas there, or solar, for example, which is, it's not, as you mentioned, it's intermittent. So, and battery technology, while developing rapidly, is not good enough to keep solar plants producing at the same level. So you got to come up with that, for 24 hours, right? You can keep the same kind of juice coming out of them for, at 4 or 5 more hours. And that's pretty amazing too. But you have to have other sources of energy to get that done. So anyway, but it is still a lot cheaper than building nuclear. So
Yeah,
that's
it is. It's kind of a pity. If I had a magic wand, I mean, nuclear would be the best thing for the planet in terms of emissions. If we could just go all nuclear, it's a zero emission thing. Yeah, you got the nasty issue of what to do with the waste, but I think much of the world realizes or believes that's the much lesser problem than pollution, which causes all kinds of health problems. In China, it degrades the buildings and the cars. You can physically see it. And I'm guessing, just like with coal, right? I mean, we've got
yeah.
ancient coal plants. One of the best things we could do for the air would be to build new coal plants to replace those old coal plants, ironically. But, God forbid, anybody gets allowed to do that, right? So nuclear kind of has a similar version of that problem. I just wish it could be different. I don't think it's going to be. I think you're right, Roger. Let me jump to 2 lightning round questions, and we can wrap up. It's been
Okay.
fantastic. I'd love to have you back on as well, by the way. MLP. So we had an MLP boom in the U.S. Right when I was running my newsletter. I think it started around 2005. That's when FERC let them embed taxes they would have paid had they not been an MLP in their cost of service. And that lasted until around 2018, but I think around 2015 or so, the MLP started to go down. I've
Right.
noticed they've climbed back up a little bit, but they're still like 40% of their all-time high, let's say. Uh, they still pay some nice yields. How do you feel about MLPs these days?
I think the ones that have survived are going to do quite well over the next 5 years or so. I do think we have a chronic lack of investment in oil and gas, which we still need a lot
Mhm.
of. And this is a long-term trend. We're, at about 10 years we've seen very compressed investment. Um, Part of that's NIMBYism, right? Or it's just a lot of projects have been tied up in the courts, so no one wants to build these big infrastructure projects. But also it's the discipline of the shale patch, which also you don't hear commented on that much. But I mean, the companies with prices coming up really didn't ramp up production behind them like they had 10 years ago, right? And you're talking about how MLPs really dropped off a cliff there. At that point, I mean, that's when oil prices peaked and oil prices came down. The Saudis flooded the market. And even though infrastructure companies, pipelines, the typical MLPs, they make their money off fees instead of, it's not purely tied to commodity prices. But, the producers pulling in their horns meant less volumes and
Yeah.
then expiring contracts. Some of the people went bankrupt. So they had a massive shakeout, and things got turned from being, very swashbuckling, I guess, to being very conservative. And that's kind of where they still stand. I mean, there's not an appetite for taking a lot of risk for producers or for infrastructure companies. So I think we're running into a situation where we're going to have a real shortage of pipelines and related infrastructure. And I think you see that with the contracts that companies are signing now, because that 4 or 5 years ago there was this you heard a lot of talk about a contracts cliff where suddenly these contracts would expire and the pipeline owners would have to either rely on spot market transactions or else sign contracts for much lower fees, and then would become much less profitable, and so on. That was part of the big shakeout that really barred these companies from having to being able to access capital markets on a reasonable term. But the end result being a lot less stuff built now, things being challenged. So, now markets are tightening up again. These companies have gone through, by going through this big adjustment, they dramatically slashed debt. So now you're seeing, and they did that by really reining in capital spending. Right, many cases, all but about 6 companies cut dividends or eliminated them in that space. So they use the extra money to cut debt, and the result is their balance sheets are stronger. They don't rely on outside capital markets to fund capital spending plus their dividends. In fact, a lot of them have money left over to buy back stock. So they're just in a much better place financially at a time when their their assets are, I think, becoming more and more in demand, and the market's really tightening. So typically these energy cycles are multi-year affairs. I think with the fact that investment has remained so compressed, I think this one's probably going to run longer and be a lot more explosive than it was in the past. And these MLPs, these pipeline companies, they tend to be the last to participate. So while we have had 2 or 3 years of, as you pointed out, of generally decent returns. I mean, even last year when the average producer was down, the average midstream, or the Alerian midstream MLP index, was up about 26%. Mm-hmm. Or if you cut out the dividends, it was up, 15, 16%. So that's pretty extraordinary. And I think it's a sign of a lot better to come. So we're really focused. We have a service called Energy and Income Advisor. And in that, we're very focused on what I call the best in class midstreams. There's still a lot of smaller ones out there that are burdened by a lot of debt. I think we might see a bankruptcy relatively soon. But the larger companies have refocused on the areas of the country where there's production, where things are more reliable. Places like West Texas, the Permian Basin out there, places near the coast where there's LNG export, liquefied natural gas export facilities. They've really kind of conservatized everything from operations, assets, balance sheet, downsize. So they're in a really good place, and I think that we're focusing on them pretty heavily at this point.
Yeah, and at least it used to be you couldn't build a pipeline next to another one. You had to have a demonstrated economic need. So it was kind of like a mini monopoly or quasi monopoly, which is kind of a nice protection too.
That's also the case. Yeah, in fact, you see that challenged in some of the areas where there's more LNG that's going to be exported and there are more facilities being built. And so there are a couple of cases that are moving through the courts, and we'll see what happens. I think more than likely there's enough business for everybody in those areas. But yeah, there just has been, compared to 10 years ago, when pretty much, I mean, the Obama administration, contrary to popular belief, basically never met a gas pipeline it didn't like. I mean, the FERC approved everything. And, there was the Keystone pipeline, and that was almost every oil pipeline they approved, except for that one. So it became a lot harder to build pipelines, ironically, during the Trump administration. Opponents became much more well-funded. That was also at a time, and to do things in the courts. And it was also at the time when, the funding vehicles, the MLPs, really dropped off a cliff. So, the funding became more expensive. It became more expensive to, going through the courts to build stuff. So that it just dropped off a cliff. Of new construction. I think that's, again, a really big factor, and not a lot of people are looking at, but will loom very large. I mean, to me, it seems kind of crazy, like we said, that New England is starving for natural gas, which they're importing via ship, and the LNG process, it's way more expensive than
Yeah,
bringing it.
it's ridiculous. Yeah, there's no other word to describe it. Ridiculous. Yeah.
Yeah. And it's just, a short, a couple hours drive away. There's supply for them. But,
Yeah, it's like me ordering Uber Eats from Baltimore when there's a restaurant right outside my house near Washington, D.C., right? I mean, that's basically
yeah.
what they're doing. Yeah. Yeah.
Yeah.
Okay, so two quick questions, Roger, and then I'll let you go.
Okay.
Alternatives per that EIA chart I was reading from are projected basically to double between now and 2030, which is quick in terms of the portion of generation. This idea of LCOE, is levelized cost of electricity, it gets a lot of heat. If you dig into this, I guess those on the right politically tend to attack it because they don't think the concept is sort of to neutralize or make a fair comparison for different forms of energy, because you got
Right.
things like nuclear, which have a huge upfront cost and more of a moderate fuel cost, whereas you have other things that have an upfront cost and no fuel cost, like a solar panel or a wind turbine. And so how do we standardize this? And those on the right say, oh, you're not accounting for intermittency with the alternatives. Those on the left will say, hey, you got this coal, it pollutes like crazy. You're not accounting for all the public health problems, right? So nobody's totally happy with it. What do you think that concept survives, or where does it go in the future?
I mean, people like to have things simplified for them. So that's the main thing that, LCOE has going for it is, you can condense it down to a number. You say, this is the cost of this. But of course, the main problem I have with it is that it is just too general and broad. I mean, I think it's useful to have that as a figure, but you really have to take it down to the project level.
Mm-hmm.
But look at this offshore wind. LCOE across the board is what, 3 times what it was like a couple of years ago.
Wow.
That's
Wow.
just useless to me if I'm trying to figure out what's the best way to serve my customers, right? As just putting that hat on as a regulator or as a utility. And you have like the facility in Virginia, which Dominion's locked in 92% of the cost. It appears to have gotten that cost inflation in hand, but that was enormously controversial a couple of years ago, and they had to basically, I think the cost of building that project was a change in the regulation, which has actually made it a little more difficult to operate in Virginia. It's still a favorable regulatory environment, but that's a pretty good indictment of, looking at LCOE and saying, okay, this is what's going to cost. I mean, you really, in order to make that a meaningful figure, you've got to have locked in the cost. And obviously, yeah, like you say, I mean, with a solar panel, the cost, I mean, it's really more relevant, I think, in terms of power sources where you have an upfront cost, and then, like with a solar facility, right? You can site it, permit it, fund it, build it, connect it within a year, say. You have much more control of the cost. So I would say it's much more relevant to that than, say, you're trying to a multi-year project. But it is really funny as you bring up like the right versus the left and energy. It's almost like here you have a very technocratic kind of area, right? Where, it really bears, you need pretty much a whole range of people that are proficient in certain areas, information technology, geology, I mean, all sorts of different physics, all these different areas. But you've almost gotten to the point where when you see a popular debate about energy, or you're at the point, you're well past it.
Yeah, that's the point now. Yeah,
It's nothing to do with science or anything. It's quasi-religious. So
yeah,
you either believe that everything in the country should be, solar and wind, and that's one side, and it's only because of the oil companies that we're not there, or you believe that the other side is saying, yeah, there's all these solar panels that are filling up the landfills, and it's a scandal, and it's a scam. So it's hard. I think it's hard to be in the position of actually trying to make the decisions of where you get affordable, abundant, and clean energy, when you have all this kind of political noise. So that's another risk of utilities. Just to bring it back to that, you have to see what are the projects they're building, and are they in sync with the states? Obviously, we could see a big change on the federal level in terms of what energy deserves supporting. But it's the state level where that's really where the rubber hits the road. That's the most important thing, and that's where it's going to be determined what gets built and what doesn't. And I think at that level, it is all going to depend on economics, and can the utilities come up with a plan that does what they need it to do, that's affordable, and that the regulators will sign off on, and being affordable not just in as the plan's presented, but down the road. Is it exposed to the kinds of things we've seen with the offshore wind or the Vogtle reactors in Georgia, where the costs are 3 times what they initially were thinking they would be. So it's not, there's never a dull moment. That's for
No,
sure.
no, utilities have this public notion of perception of being this kind of sleepy backwater, but it's nothing. It's quite the opposite. It's actually a very difficult job, as you pointed out. There's so many different things you're trying to optimize for, and nobody's ever totally or even happy sometimes. I mean, you're inevitably angering some groups, and it's just a trade-off. And it's kind of an argument in a way. I mean, I spent a lot of time doing business with China, and in general, I'm not a fan of that form of government, but we could use a little bit of that over here sometimes. That authoritative, just let's get this done and stop complaining way of approaching things. Roger, someone's watching this, say, okay, this sounds good. You sold me. I'm interested on this. In energy, excuse me, writ large, or utilities, let's say. Do you lean more towards sending them to like XLU, some kind of an ETF, or do you think it's much better they pick and choose individual stocks? As you pointed out, the regulatory regimes, the demographics, like the needle movers can vary quite a bit depending on where you're at in the country.
Yeah, so I have a coverage universe, I guess, in Conrad's utility investor, about 180 different names.
Wow.
Difference in performance last year between the top and the bottom was pretty close to 300 percentage points. So that's not something, I mean,
that's bigger than I would expect. That's bigger than I would expect. Yeah.
Yeah, we do have other areas that we look at, right? We're throwing in telecommunications. We have foreign companies based outside the United States. We have water companies, and so on. So it's not just it's not just the regulated utilities, but regulated electric utilities. But yeah, the difference can be quite astounding in between individual. So I mean, it's sort of, I think you're always going to get better results on any endeavor if you take charge of what you're doing. And I think, even if you're buying your own ETFs, say, that's a huge step over passively investing, just putting your money in some Vanguard thing or whatever, and it's stocks or whatever, and it's probably not run by a human. It's going to follow an index and so forth. That'll get you a certain set of results, but I think you're always going to do better in investing, and really, I mean, your health or anything, by taking some interest and spending a little time. So it obviously takes more time to pick out individual stocks. Maybe it means trying to find a good resource. I like to think we're a good resource, but there are also other resources out there too. But whatever effort you put in, I think is going to be well worth it down the road. And again, even with utilities, big difference between an individual performance between companies. And if you do, I mean, if you do, I will just say, I don't get it right every time, but I think if you do spend the time to make those determinations, it will have a meaningful impact on your performance longer term. And most importantly, I think you'll understand like what is going on with your overall money. You won't be blindsided, uh, which I think a lot of people could be uh, going forward because of that massive tech concentration in the S&P 500. They may think they're a lot more diversified in terms of investment than you might be. In fact, it might not even be the S&P. So I like to have control over various things in my life. I think that makes for better. We only have so much time in our days, but I think that makes it. It does definitely make for better results. It's what we learn when we're growing up. We put in the effort. We get something out of it, and that's what I definitely advise for people to consider.
Well, I am going to tell my dad that Roger Conrad is still on the beam. And if you agree, if someone's watching this and wants more Roger Conrad, Roger, where's the best place for them to go?
Well, if you just want to kind of check out something that I do, some writing that I do, you can check out Dividends with Roger Conrad on Substack. So you can sign up for that for free, substack.com. If you like what you see there, check us out at capitalisttimes.com. And we have we have a couple other websites there. We have Conrad's Utility Investor. So that was obviously what we were talking a lot about today. We also have Energy and Income Advisor, and we hit on some of those subjects as well. And, check out in broader detail. We do focus very much, and I think I've indicated that, we do look at individual stocks. That's our stock and trade, if you will. And so there may be more information there than there will be a lot of information there to absorb. But again, substack.com is kind of an easy way to kind of wade in and then, take it from there.
Plenty of resources, Roger. And I, for one, think you're being very modest about your ability. I think you had a ton of value in your research, and I hope that people watching go and check that out. Roger Conrad, you've been very generous with your time. Thank you so much for joining us today. And thanks to you guys, as always, for watching at home.